Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. Well, today we got the news that the bill was passed to raise our debt ceiling. Isn't that wonderful? We get to have more debt as a nation. And the market rallied 700 points. Now, if you had a chance to watch my midweek report that went out on Wednesday, right here, we were pivoting down from that green dotted line. So it looked as though we were forming a role reversal resistance. And then what happened Thursday, we rallied back up and slightly closed back into this trading range. And today, the news of the bill passing pushed the market up. Now, keep in mind, we are still in this trading range here. And the fact that we had that news breaking early on, we gapped up in the market. So remember, gaps fill 80% of the time. Now, interestingly enough, we're caught between two gaps right now. We have a gap right here that was formed today, and we have this gap right here that was formed back on May 2nd. So we're caught between these two gaps. Now, if you take out your trading checklist that I promote quite often, you'll see that that green candle on higher volume is bullish. We do have a upside here, momentum on the CCI. The stochastic is still running higher. So next week, I do believe that we do have a chance to move up towards this gap, which will be a resistance point. So let me do that. Let me draw my forecast line Monday, possibly Tuesday, and into Wednesday. Now, remember the old saying, buy the rumor, sell the news? Well, now the news is out, and I would not be surprised at all to see a little bit of a continuation of this momentum higher, but I do believe they'll sell into that at this resistance high. This is a significant resistance high that, again, keeps us in this trading channel. So that is for DIA. Let me just give you my price target on that one because I like to post that to the video. That price target is 339.50. Now, moving on to IWM, we again hit my upside target on the weekly report. It's hard to see that because the red line that I drew is behind that red candle. But here's another one. We gapped up on higher volume. Now, this is interesting because we closed with almost no shadow above that line right there. So let me erase all these now that my targets have hit. And I have to go to the weekly chart to draw where I believe the resistance is going to be. So we have resistance right in this area right here. See this? This is the role reversal that started as support back here in January, held as resistance here, held again as resistance right here at the beginning of the year. So here is the trading channel or the trading range for IWM. It's awfully familiar from what we saw in 2021. And we are now upside channel resistance of around 194 to 195. Downside support is 164 to 165. So that's why I go to the weekly chart to, again, identify that channel. Now, I do believe that momentum will continue in IWM as well. However, I do not believe we're going to get all the way up to these highs. I think we are going to move just up a little bit more and then keep an eye on the volume because we filled this gap right here. Let me magnify that for you. That was an open gap that was formed back here on March 9th, and today we filled that. So you generally see big candles on higher volume being followed by lower volume bars, especially after the gap fills. So my upside target on IWM is 183.94. Now moving on to the Qs, this is the AI craze that had pushed this one up. Now remember from last week, if you followed that report, I said we would most likely go up. We did that. We hit the target of 350.49. Now this candle is not all that bullish right there. That is a spinning top. We do have slightly higher volume, but what's interesting here is that while we have higher price highs, we have lower CCI highs and lower stochastic highs. Those are negative divergences that I point out whenever they show up. And so I'm going to erase these lines right here and draw what I think we could see. Now, because of the increase in volume, and again, it's very slight increase in that volume, I think we could go a little bit higher, but I'm going to do a two-part forecast on this. We'll see if we even hit the upside target of 361.68, but I think we're going to come right back down and start moving towards that moving average again. So upside target first of 361.68, a drop in volume. I'll even forecast that as well. Draw a little volume bar there. So it's more or less like a three-part forecast, actually. Again, 361.68 to the upside, a drop in volume, then downside target of 345.13. Now moving along into SPY, if you go back and listen to last week's report, right around the 5-minute mark, you'll hear me talk about these gaps. The green dotted line is the gap that I thought we would fill, and it did. And then I went a little bit higher on that forecast. You see that? And I said there would be a chance that we might even fill the gap that's from back here. Let me zoom into that. See, this is only a 26-cent gap or a 24-cent gap. Let me see, what is that? 24-cent gap right there from the high on this candle from August 19th and the low of this candle from the 18th. So that's, again, a 24-cent gap. And it doesn't matter if it's a penny gap or a dollar gap or whatever. Gaps fill 80% of the time. So we did fill that. And now I'm expecting the SPY to go just a little bit higher, just on the overall excitement and what they'll probably talk about over the weekend with the debt ceiling being raised. And then the reality of our economy is going to kick in. And I'll talk a little bit about that in a bit as I show you my PowerPoint. But I do believe we'll go a little bit high, just a little bit. I'm going to do another two-part forecast on this, which no one really does because it's sticking your neck out there, really. But I'm going to do that. 429.19 on the upside. I'll, again, forecast a drop in volume. Again, it's like a three-part forecast with the volume drop. And then I think we're going to make a move right back down to fill this gap that we left today. Right, so gaps fill 80% of the time, like I say, over and over and over again. Upside target because of the momentum, 429.19, then right back down, 422.26. Now, taking a look at the VIX, this is incredible. We are now reaching the lows that go back, 20 years. We're incredibly low, below 15. Can it drop a little bit more? Well, we'll have to see. Maybe on Monday we could go a little bit lower on the VIX, but I'm going to forecast that we will go higher on the VIX and go up to that moving average. I still have this target in place because the VIX is also in this range, and with the VIX being so low, I mean, I'm not really sticking my neck out all that much with the VIX because it's an oscillating index. It's not a stock, but I do believe it's going to get back up to 1720. Now, remember, I've been talking about the one-day VIX and what that is doing in relation to the 30-day VIX. And you see the 30-day VIX here has dropped 3 days in a row, but look what's happening with the one-day VIX. You'll see that we have higher lows forming here. Isn't that interesting? See, we have higher lows forming, and the one-day VIX closed lower, but it closed with a green candle. And the stochastic is starting to hinge. The CCI is approaching oversold, second lowest reading that the one-day VIX has had. So I'm going to start forecasting what I believe we're going to see in the one-day VIX for you day traders out there and those option traders that trade the 0 day to expiration options. I think we're going to see the one-day VIX get up to 1524. Now I'm going to mention one more stock, and that was in relation to Marvell, MRVL. Remember, last week's title of my report was First the Pump, Then the Dump, and I was showing you the evidence of how the institutions manipulate this and other stocks like this. You could see that on Friday we had that big green candle, and I showed you what it looked like on the intraday, and what's happening, they're dumping it. They're dumping Marvell. You can see that it dropped right back down. We have a red candle. Now, you have to understand, Marvell dropped today while the Dow was up 700 points. So they're selling into the AI stocks. You can see the stochastic is hinging lower here, and the CCI crossed with a sell signal. Another one I want to show you that was another pump and dump candidate was AI. AI was another pump and dump. They rallied this thing up. The very next day, a bearish Harami showed up and it came right down. Now, the momentum is still heading lower on this. And a lot of people got caught on the long side with this because of that craze. And that's why I'm trying to warn people about that you pay attention to the charts and read the manipulation that's coming into the market. Now, let's go to the PowerPoint because the bankruptcies here on a corporate level are the highest levels they've been, at least at this point in time, since 2010. Right, so this is not a surprise because I've been talking about this, especially in the tech sector. So pay close attention to this because remember, all the big rally because of the relief of the debt ceiling, and we rallied because, the U.S. is not going to default. So we avoided the bad news and the markets rally. But there's more bad news layered into this story that no one is really talking about. Of course, the fund managers want the price of the market to go up, and many investors do as well. I'm not trying to rain on that party, but you have to understand that there's a lot of things going on in the economy that are not being reported on, and that's my role. At least that's what I believe my role is here for you, is to uncover the news that's not being covered. Now, this is from S&P Global Market Intelligence showing these bankruptcies. And we're not over with yet here. This is just showing what's happening January through April. And you have this first quarter activity being pretty aggressive here. For all we know, for the rest of the year, the bankruptcies might come in much, much higher and maybe even higher than what we saw in 2010. So this is a story that we'll continue to report on as it develops. Now, another thing you want to look at, and I've been talking about the debt that's being taken on by consumers throughout the U.S. This is a very interesting chart that's brought to us by the New York Fed Consumer Credit Panel. And I want you to pay attention to this dark blue line. That's credit card debt is starting to ramp up in a pretty aggressive way. Auto loans, same thing. Look at what we have here in mortgages, right? People taking mortgages out. And that is, again, we got the three main drivers in what's getting people into debts: credit cards, auto loans. They're going out there, they're still leveraging themselves, and they're buying houses. But with regard to the real estate market, I'm going to get to that. It doesn't look as bullish as you might think looking at this particular chart and how mortgages are going up. In fact, if you look at the new home purchases by investors, this is collapsing. This is the biggest collapse, or the most on record, and that's all shown here in these gray bars that you see right here. This is the biggest drop in investor home purchases on record. So that's a leading indicator in my book, because if investors are pulling back, that means that they believe there's a bubble. Investors don't buy into markets that they think are going to collapse. So that could be a tell here that we, again, have to pay very close attention to. Now, again, one of the things I want everyone to look at is the rate at which mortgages have been increasing since 2020 and 2021. Look at this spike in the interest rates. I mean, we were down, 2.9% not too long ago. Now we're pushing over 7%, and you can see this pivot. It's still moving higher. So that could put a little bit of a damper on the real estate sector, because people who are locked into mortgages way down here may not want to sell their homes and get out of that low monthly payment to get into a newer home with a much higher monthly payment because of the interest rate that they're locking in. That's putting a hurting on inventories. For you real estate folks out there, you know that the inventories are drying up. California, Florida, New York. And so you would think that because the inventories are drying up, that would cause prices to go up because of the supply and demand, right? If there's less supply, more demand, prices go up. But it's very interesting because we got like a locked market. People are not selling their homes and not buying homes because of that interest rate right now. We'll have to see how that develops. Now, my final slide here is relating back to what we were talking about a couple of weeks ago with the tech companies and the tech sector laying people off. Now, this is the biggest increase in layoffs since 2001. Look at that. And again, we don't know if that's going to continue to go higher. We don't know if we're going to beat that 2001 number back there, but it is something that is definitely on the rise. You can see month after month, with the exception of back here in the COVID crash, we are seeing enormous increases in layoffs, in particular in tech. So that is the weekly market report. Stay tuned to my midweek report. I'll be traveling next week, so I don't know if that midweek report is going to be coming out right after the close. So I'll have to see if I'm going to be in the air or not, or if I'm on the ground and in my hotel, I'll be able to do that for you. But I just want to set your expectations now so that you're not surprised when the midweek report doesn't come out exactly at 4 o'clock. So you have a great weekend, and we'll talk to you next time. So long. There's no more damaging formula than to mix emotions with money. Listen, we're made up of emotions. We have fear, we have stress. The trading checklist helps take that all away. And now, wow, take a deep breath, relax, and enjoy the ride. You might be completely foreign to technical analysis. You may not even know what a bullish engulfing candle is or a shooting star. That does not matter. The great thing about what I'm showing you right now is I'm taking 40 years of experience here and I'm breaking it down to 7 points that you can follow through a trading checklist. Look at any stock, any ticker symbol using the 7-point checklist that I have and determine who is in control of that price action. I'm AJ Monte, and this is my 7-point trading checklist.